We're about to go live here. Well, in fact, we are live if you're seeing this already. What I'm doing is I'm just getting myself set up on all of the social media sites that I go live on. As you probably know, today we are going to talk about emotions and investing as we always do. And what we are going to focus on today is going to be a couple of things. One, we're going to talk about what gaps are. So, what a gap in a in a chart, which is the story of the market, telling you the story of the market, what that means, where they come from, why does this weird space show up? And for those of you that aren't familiar with charts, there's always a way to tie in the fundamental story to the. I'm going to use the term technical, although it is not technical analysis to use a chart to read the story of markets. If you are reading the story of markets and you are looking for the emotion behind that story, and then realizing that those emotions are the actual driver of that story, of that market, it's not exactly technical analysis. So I don't like the term. I do use it to decipher the difference between kind of fundamental things going on versus the story that's being written via a chart. But I would encourage everyone not to think of it as technical analysis. All you're doing is reading the language of the markets, because unless you are some super freak that has the ability to read every single thing that comes out every day about every company and every market, that is extremely hard to keep up on. And there's another big problem with even trying to keep up on that information, and that's you never know if you're being told information that is meant to evoke a response from you, where it's basically an advertisement. Because some of what they call fundamental analysis or company analysis or market analysis is just that. It's more of an advertisement than anything. So there really is only one true way to read the story of the market in an unbiased fashion, and that's to look at what's actually going on. If you look at what's actually going on, you then have the ability to decipher where the market's at, who's participating in the market, what that typically produces as a result as far as price goes. And this goes for forex currencies, this goes for crypto, this goes for commodities, any commodity, right? So metals, oil, whatever it happens to be. This goes for all of those things. When you know who the players are, who's in control, and what emotional response they're trying to evoke, because you are reading the story of this market via a chart, then you have a very good idea of where we're headed. Okay. So we want to talk about gaps. Where do they come from? And we're going to talk about something fundamental today. And the thing that we're going to talk about from a fundamental standpoint is called buybacks, right? This is when companies come in and they're buying back their own stock. There's a reason that they do that. So from a supply and demand standpoint, if demand remains at a constant, and so we have supply here and we have demand here, and I buy back some supply and demand doesn't go anywhere, what should happen to price? Price should go up. If we have a lack of supply on the market because a company is buying back its own stock, and we have a constant demand, a steady demand, prices should rise. Why would anyone ever want that to happen? Well, if you are a publicly traded company on the stock market, if you are a metal supplier, if you are a miner, and you have gold, why would you want the price to go up? Look, prices going up is what they desire. So we're going to talk a little bit more about the buybacks, and then we're going to talk a little bit about gaps. So how can that create a gap? Well, most of these companies are going to put their orders in at end of day, and they're going to buy a bunch back, which is going to do what? Pull a bunch of supply off the table. This is one way that a gap is created, because now the opening price is actually higher than the closing price. You have this big hole here, right? And that's in the chart. That's in the story of the stock market. This isn't sophisticated technical analysis, as you can see. This is just taking a fundamental situation and applying it to what you're looking at. And if you can take a fundamental situation and apply it to what you're looking at with logic, you have an idea of what should happen. So, how does this apply to gaps? How does this apply to the story? Well, in any business, okay, there is the side that provides the service or the product, right? That's your retailer. That's your wealth manager, right? He's supplying a service. And there's the side that supplies the product and the service. And then there's the side that consumes the product or service. And that's the buyer, right? So when we're looking at markets, what we're looking at is your suppliers of the services and products are a few different people, right? So a company, ultimately their product in this scenario is their stock. Then you have your brokerage firms and wealth management firms. They're a service that helps you determine what stocks or commodities or bonds are best for you, and they help you create a financial plan in doing so. And then you have your market makers. These are the people that help create that transaction. So these are the people that don't care whether a price rises or whether a price falls. What they do is they create the ability for this transaction to occur. And what they want to do is they want to get paid for that ability. And what they want to do is keep their risk at zero. They want to carry zero risk. And they do this in a lot of ways. There's a lot of undercurrents in the market because they're constantly hedging everything that they're doing. They, in fact, have to hedge their hedges to get their risk down to a zero. This creates a whole nother level of undercurrent in markets, okay? And that undercurrent creates magnets, pushes and pulls. So it can pull prices in certain directions based on what they're doing. But for now, what we're going to talk about is we're going to talk about that middle group. We're going to talk about banks and brokerages and hedge funds and institutions that are actually buying and selling and providing a service to you. And we're going to talk about the companies that are involved, because that's what buybacks are. Buybacks are actually the company itself buying back their own stock. Now, here's an interesting point to be made by Goldman Sachs recently. Goldman Sachs has said that they estimate there's going to be buyback season's back. Okay, so now we know fundamentally that buyback season is back. It's my son at the back door there. We're live, so I could hear him. Buyback season is back, and they're estimating that we're going to have 5.5 billion inflows until the 14th of June of this year. So what that tells you is that supply of many companies is going to be bought back, which creates artificial buying, right? It is buying. The word artificial buying maybe shouldn't even apply here. It is, in fact, buying, but it's just a company buying their own stock. But what does that do to price? Well, it drops supply, which should increase price. And we're going to see that through June. Now, if you buy back a lot of stock, conversely, what do you have to do? You have to put that supply back into the market. So if we know that all this supply is being pulled off the market, we also know what's coming is that they're going to have to put the supply back. And what they'll do is strategically, what they will do is they'll try to reintroduce that supply in a manner that doesn't overwhelm the market. Now, right now is a great time to overwhelm the market by pulling supply because that drives prices up. However, if you overstimulate the market by pushing a ton of supply out, you're going to drop your own prices. This is not the way the market works. And the reason I bring this up is because when we talk about gaps and how they're created and what they mean, you have to realize the reason that gaps fill. So something that we always talk about is the story of markets and how they work. And everybody uses the term technical analysis, so I'm doomed to use the word too, even though I don't agree that that's what it is. So the reason a gap is going to fill is because the supply that I take from the market, I have to reintroduce to the market. And let's talk very quickly about how the market actually moves. We go over this all the time. This isn't a new subject. You have your creators of the product, your providers of the product, your providers of the service. They provide the service. Then you have the retail end, the people that are actually buying the stock or selling the stock. The way a market actually moves is a couple of ways. They're buying and selling to those retail investors, right? Those smaller investors, if you will. And we call and so they're buying, and then where is it coming from? Typically from the trading desks of these larger institutions, and that creates ebbs and flows. Now, if you are in the retail space and you are the store owner, it is your job to regulate the prices within your own store. It's your job to make sure that your sweatshirts this week are going for $19.99 and not next week going for $39.99, because what you'll end up having is a user base. You end up having a user base that is used to wild volatility. Volatility is a term that we use all the time when we discuss markets. So what you'll do to reduce that volatility is you're not going to want these giant price fluctuations. Now, in your typical retail store, I realize that some of this is out of your control. Some of it's within your control. The same thing goes for this particular marketplace, for this particular store. There's certain things that can be controlled and there's certain things that can't. And that's why sometimes when they create these large gap ups, so right now in this buyback, I imagine you're going to see prices gapping up, because as we talked about yesterday in the NASDAQ and in the S&P, it doesn't appear as though these large institutions are very interested in buying at these prices. But the good news for them is the companies that operate within this marketplace are interested in buying back their own stock. Now, there can be a couple of reasons for that. Maybe one of the reasons is, in fact, that they see what all of us see, that know how to read the story of the market, and that's that these institutions are interested in their stocks at this price. So whose emotions need to be affected to change this scenario? You got it. The emotions that need to be changed are the retail investor, the smaller investor. You need to get this person excited. It's, for one, a big group. It is a big herd. And if you can get it moving in the same direction, you can drive prices with it. What is the one thing that most of that group pays attention to that they probably shouldn't pay as much attention to when they are evaluating their positions, their investments? Price. I try to explain all day and all the time how your emotions are affected, but the ultimate way to get a retail investor, to get a smaller investor, somebody who's buying smaller portions, excited is price. It shouldn't be. Price should be the indicator of where this particular marketplace is at a certain point in time. It should not be the determining factor of buying or selling. Now, if what you see is a ton of trading activity after prices have fallen, we know that most likely this is big institutions buying, and we want to stay on the same side as them. So yes, in a way, we're using price, but let me tell you, when you're hearing and seeing, oh, prices are moving up, you're missing the boat, you're missing the wagon. When this is the stuff that you're hearing, you're missing nothing. And let me tell you something. The one thing that gets the best of human beings is time. Time really can get to you. When something drags on, when something takes longer than you want it to take, when you feel like every day I've missed another percent, I've missed another 0.5%. Oh, the market's up 4% and I'm still sitting here. In fact, I'm not sitting here, I'm hedging against it. Oh, it's been 6 months. That's an incredible tool to be used against you. That right there, everything I just did, all of that overthinking. You're sitting at a high price. You can see that. You can see the prices are up 35%. You can see the trading activity is through the roof, or at least much, much higher than it has been. So you know, and let's just say that it's April. You're well aware in April that what's going on up here is what we refer to as churning. So in the story of the market, that is simply the exchange of the product, stocks, bonds, currencies, mutual funds being given off, sold off to the smaller hands. I don't like to use the term weaker hands, although your emotions being used against you is certainly not a weakness, but weaker hands really means less knowledgeable hands. And I probably prefer that term. You just don't have as much knowledge. And why don't you have as much knowledge? This isn't your job. I mean, you're not in here every day watching the ebbs and flows of this thing, watching how it moves, why it moves, when it moves. And you shouldn't be. You shouldn't be doing that. First off, that will probably get you in more trouble because it's not your job. But what that means in April, when you see trading activity at a high and price up 35%, is that those more knowledgeable hands are selling off to those less knowledgeable hands. And for a while, they will do it at a speed that is meant to keep the less knowledgeable hands engaged. And as we've talked about before, they're slowly pulling out those steps, those support levels. They're pulling them out. And then finally, when they've sold off as much product or supply to the less knowledgeable hands as they need to, they will simply sell the rest. They will stop supporting prices, stop inserting those steps, those buy levels. They'll stop putting in buy levels, and the market will turn and drop very quickly. As we talked about a few days ago, this is the reason that stock prices tend to fall so quickly and they take more time to rise. They fall very quickly and take more time to rise because those large institutions, the people that are working within the market every day, have pulled out their buys. They've pulled out their purchasing. They have a target somewhere below you. We talk all the time about how to identify those targets, where those targets are, and how you use cash management to make sure cash management and risk management to make sure that you're buying at the same levels that they're buying at as prices fall, as those prices fall, so that you are not emotionally taken advantage of on the way down as well. So what is a gap and how is it used against you and why does it make any sense? So now we've moved on to gap. So what have we covered today? We've basically established that the more knowledgeable hands tend to buy and sell product and services to the less knowledgeable hands. And the way any salesman operates, this is not a bad thing, mind you. This is just the way human beings work, is your emotions. They manipulate your emotions a bit. They get you excited when they need you purchasing, and they get you afraid when they need you selling. When do they need you selling? When they want to buy. When do they need you purchasing? When they want to sell. Now, if you know that someone is in control of a marketplace and that is your game plan, you should follow those that are in charge of that marketplace, right? That makes sense to everybody, right? Now, let's talk about the people in charge of the marketplace, because this is where gaps come in on a chart. So again, for those of you just joining, a gap on a chart or a chart itself is the story of the market, whatever market you're looking at. So whether that market is a commodity, whether that market is a currency, whether that market is a stock, whether that market is a crypto, that's the product and that's the service being provided. And the way we read the book of those products and services is we look at a chart. People call it technical analysis. I disagree. I call it reading the book of the market. That's all that it in fact is. And for those of you just joining, I haven't done any sales pitch in the last 20 minutes as I've been going over what these gaps are. So let me tell you who I am and what it is that I do. I worked for two of the largest firms on Wall Street, Merrill Lynch and Wells Fargo Advisors. I was there for nearly 20 years. I have developed a system that helps investors and advisors and other professionals alike identify the footprint of these larger institutions and the emotion that they try to evoke in you or invoke in you. So if they're trying to invoke excitement, we know that they want you to buy, which means they're selling. We stay on the same side as them. We sell with them. If they are trying to evoke fear, we know, or invoke fear, we know that they want to be buyers. They want you to be a seller. We make sure we stay on the same side of them. It's a three-part system. Effectively, what you do is you establish your financial plan, your goals, and what you'd like to achieve. The next step is my VIP mentorship EQ mastery course, which covers three main topics: risk management, cash management, and investment management. Those three pieces make up everything you need to do inside your investment portfolio to make your assets work for you, to stay on the same side of the market as these different institutions are on. And I show you how to do that. And then the third step is simply subscribing to my newsletter. You subscribe to my newsletter, you get updated on typically a bi-weekly basis via video and my newsletter, so literature. So you get to read it and you'll get to watch it. What I'll do is I'll show you what I see through the lens that I see, and I'll show you what I'm doing with my own portfolio, so you have the ability to continue educating yourself through my lens, okay? So you will actually see my portfolio. I run several different portfolios. Some of them are one of them is a buy only. One of them is a buying and selling, so long and short. I'm looking to go purchase the strong. I'm looking to sell the weak, so make money in both ways. And the third and final portfolio is what I call the zero risk portfolio. So what I look to do there is I am always buying and I'm always shorting, keeping my risk at a minimum. I have to tell you that portfolio has done extremely well in good times and in bad. In bad times, we see positive returns. In good times, we see positive returns. I have to throw in there that historical results don't indicate future results, but I've been doing this for 25 years, and I have no reason to tell you otherwise. So step one, we go through and we get your financial plan set up. Step two, you do the VIP mentorship course. And step three, you subscribe to my bi-weekly newsletter, which is actually a video newsletter and a written newsletter as well. Okay, back to now that you've got my little pitch there, the QR code's at the bottom of the screen. For those of you that are on TikTok, feel free to direct message me or make a comment if you have a question. I'm happy to reach out and talk more about this and send you some more information if you need it. But let's get back to those gaps. So what are gaps and why are they inefficient? So why do they always seem to fill? So you have these holes that show up in a chart, the story of the market. And for whatever reason, especially within indexes, not always within stocks, not always within commodities, almost always in Forex and in currency, and almost always within crypto as well. Why do those holes seem to fill? Well, if I am the market, if I am one of the biggest drivers of this market, if I am one of the people that keep this market going on a day-to-day basis, and my goal is to buy and sell to create profit, right? So I sell to less knowledgeable hands, I create some fear, and I buy back from less knowledgeable hands. If my goal is to do that, what do I want to keep price? I want to keep price efficient. I want to keep price flowing a penny at a time. So regardless of what we're talking about, or if you're in Forex, it's a pip at a time. So I'm always going to speak in terms of stocks because I think most people understand that a little better. But what I want to do with an index's price is I want to move it a penny at a time all the time. Why don't I want it jumping $1? Well, if my goal is to continuously be buying and selling, why would I want price to increase $1 where I then have to buy it $1 higher than I had to at close yesterday? I wouldn't. Think about it. If there's a product you wanted to buy and you were in control of the price, for the most part, okay? I'm saying that, but for the most part, you're in control of the price. Why would you ever want that price to jump where you had to pay more than you had to pay a minute ago? You wouldn't. That's absurd. You would never want to buy something for more, $1 more, when you could have it for a penny more. But why might you do that? Simple. That will invoke an emotional response from the less knowledgeable hands, from retail. They will get excited when it jumps $1. They will go, woohoo, I'm missing it. It just jumped $1. We got to get involved, everybody. It's up 7% at the open. There's only one group of people that gets excited about that. And that's the group of people that I'm always talking to and sort of trying to, they just have less knowledge because it's not their job. They're not expected to know this. But if you realize that when you feel excitement like that this is bad, if you can just in your mind turn it around, right? When you see something up 7% at the open, this is a selling opportunity, not a buying opportunity. And that is why you will oftentimes see in a market that we are not trying to drive prices up because we're looking to sell. So I'm playing the institutional side. I want to sell to you. My trading desk has acquired a lot of these positions. I want to make that profit real in terms of cash. The only way to make that profit real in terms of cash is to sell to you. So I want to push that price. I want you excited. When you're in a market like that and you're on the less knowledgeable side and there seems to be a lot of excitement and joy based on the fact that prices are moving so quickly, you should be the opposite. You should say to yourself, oh, wow, why would anybody that was in control, quote unquote, right, to a certain extent in control of a market, want prices to do this? Because they have to buy at these prices too. They don't. They're not buying. They're selling. They are right now, they are the holders of the inventory. They are in control of the supply. So if they're in control of the supply, they're distributing that supply at a higher price, increasing their profits. It's really that simple. That's what's going on. So right now what's happening is me, the institution, I'm not excited about these prices. And so I'm not willing to purchase. And so, or I don't need to purchase because right now what we know is buybacks, company buybacks are hitting the market again at a rate that Goldman Sachs estimates is going to be about $5.5 billion of daily flow. $5.5 billion in daily flow. So they're going to pull their own supply off the market. How do they do that? They have to buy it. They have to buy their own supply. So ABC stock, Google, Tesla, whoever, the companies, everybody knows what a company is, a publicly traded company. They're buying back their own stock. So what's that going to create? It's going to create purchasing. It's also going to create less supply on the market. That's called float, by the way, folks. If you hear the term float used when someone's talking about a stock, what's the float? They're saying how much is available to be purchased. How much stock is available to be purchased? That's the float. Well, they're removing some of that. So now what you've done is you've removed some supply. You have increased buying because the only way to buy back your stock is to buy it on the open market. And that's going to create price jumps. That's going to create gaps. We woke up to a gap this morning. May 15th, 2024, we woke up to a gap. That gap filled. What does that mean? Prices drifted back down to the close of yesterday, and then they began to move back up. Why? Because large institutions, brokerages, wealth management firms, hedge funds, they're not buying at a higher price than the close yesterday. So if they are interested in buying, or if they need prices to come down so certain companies can do certain buybacks at a better price, they're going to allow price to drift back down to the close yesterday, where all the people that got excited at the open are now probably not excited. Now they go, oh no, I just bought. It was up. It was the index was up 1.5%. So if you're buying a stock that moves faster than the index, let's say your stock's up 4%. Now it's even on the day. It's technically even on the day, but not for you because you bought it at the gap up in the morning because you got excited. You're down 4%. You're going to sell it back. And guess what? They're going to come in and buy it and price moves up. This is how ebbs and flows of market moves. And this is why gaps a lot of times are artificially created. Gaps are many times artificially created, folks. They're artificially created because it makes you excited. Your emotions are the driver in any sale you make and someone makes on you in life. And sales aren't bad, right? Buying a car isn't a bad thing. Buying a car at a bad price and a high interest rate's a bad thing. But guess how you do that? Get you in there smelling the leather, let you feel the power, put a little of this and a little of that in the engine to give it a little more vroom vroom, make a little more noise, that tailpipe. perhaps. Yeah. Now you're in there buying at a worse deal